Welcome to everybody present here. I welcome everybody to today's program, India's 116, Lease, Understanding Accounting under India Lease Accounting. So, we have our speaker, CS Shobana Giridhar with us. Ma'am, I request you to occupy the stage, ma'am. Before we go into the session, I'd like the members to raise for the ICAI motto song. So, thank you. Before we begin, I'd like to have a short summary of Shobana ma'am. Shobana ma'am is a chartered accountant, a certified information system auditor, and a commerce graduate. She has worked extensively with multinational companies and domestic firms, specializing in process documentation, compliance reviews, and internal controls. Her expertise span across various domains, including technology, manufacturing, and power sectors, with a strong focus on shared service centers in India. Shobana's advisory engagements include financial reporting and analysis, transition monitoring, and control framework reviews. She has been instrumental in reviewing financial reporting for various geographies at SSCs in India, as well as process documentation and internal control reviews. On behalf of SIRC of ICAI, ma'am, I thank you for accepting our invitation and being with us today. As a token of our appreciation, I would like to invite C.A. Jaishankar sir to kindly present a memento to C.S. Shobana Giridhar as a gesture of our gratitude and respect. Thank you, sir. We look forward to have a productive and inspiring event, ma'am. The stage is yours.
So thank you. Good evening, everyone. Thank you for coming to the session. So the topic for today is on Ind AS 116, which is the accounting standard for leases. So this is pretty, easier topic than other financial instruments, derivatives, and all others, but not as easy as PP&D and inventory. So we will go into the accounting standards and the broad things which I will be covering is on the scope, on the accounting parlance of a lessor, lessee, and what are the various definitions with respect to leases, what are the various aspects we need to factor in lease accounting. So it is identifying a lease term, lease accounting, in the sense lessee accounting, lessor accounting, and sale and lease back. So this is a general introduction about lease where Ind AS 116 has to be applied consistently to contracts which are having similar characteristics and in similar circumstances. So Ind AS 116 is applicable, as we know, for all leases except leases to explore for use of minerals, oil and gas, which is dealt with separately under 106, biological assets dealt under Ind AS 41, service concession, which is dealt again separately under Ind AS 115, licenses again under revenue from contracts and customers, and licensing agreements for motion picture, which is dealt under intangible. So other than these, for all leases, Ind AS 116 will be applicable. we go into the lease accounting relevant definitions, which is very critical. As we know, the commencement date, the fixed payments, the variable lease payments, your lease incentives, these are all the common terminologies which we will come across in lease accounting. Lease modifications, where if there is a change in the scope of the lease, then what has to be considered as part of the lease, what has to be the revised lease term, the discount rate, everything. Operating lease, then what is a finance lease, the period of use, and of course sublease. So here if we say with respect to commencement date, normally the agreement will clearly contain what is going to be the date of commencement of the lease. Otherwise, if there is any occupancy or handover certificate which evidences that that is the agreement commencement date, we consider that date as a commencement date. When we talk about variable lease payments, the consumer price index, that keeps changing, and on account of which your rentals also keep changing, because if there is a change in the consumer price index, and based on some contingencies also the rentals keep changing. So all these has to be factored into, and because of this change in the inflation index, the change which will happen has to be factored into your lease payments, in your variable lease payments. Fixed lease payments, of course, they are going to remain fixed for the lease term. There is not going to be any change. When we say lease incentives, it is any discounts or any incentive which is given by the lessor, which you will consider as a reduction from your lease rentals. So Ind AS 116 definition of a lease, where it is a contract or part of a contract which conveys the right to use, which conveys the right to control the use of the identified asset. Very critical is the asset has to be identified for a period of time, which is also operating lease is where substantially all risks and rewards doesn't get transferred with respect to the underlying asset. We have a slide separately which shows what are the conditions that need to be satisfied to be called as a finance lease. The lease which does not satisfy those conditions will be automatically classified as an operating lease. Especially your short-term lease rentals, where you keep paying a rent and you charge it off as your operating expenses and not as an ROU asset and a lease. You don't have a ROU asset created for that. So that comes under your operating lease. Transfer of title will be in finance lease. At the end of the lease, it will get transferred. If one of the option is you can purchase, or after the lease period, predominantly after the use of the lease period, you will renew the lease, or you will mostly renew the lease. You will also have the option to purchase. That is there in the finance lease. Operating lease is simply where it is basically in the nature of short-term lease. Year on year it will get renewed, and there is no option of purchasing it and all in an operating lease. So transfer of title cannot happen? No. So here it is a right to control the use of an identified asset for a period of time in exchange for a consideration. So the commencement date is the date at which the lessee actually takes control of the underlying asset. So identifying a lease. So it is very critical that at the inception of the contract, an entity should assess whether that contract contains a lease. So a contract is a lease or contains a lease if the contract conveys the right to control the use of the identified asset. So it has a right to control the use of an asset which is clearly identified for a period of time in exchange for a consideration. So all these has to be satisfied to call it as a lease. And important thing is the supplier should not have the substantive substitution rights. So does a supplier have the ability to substitute the asset during the period of use? If the supplier has got the ability, then there is no right to control. If the customer cannot clearly determine, or you presume basis the terms of the contract that the supplier does not have a substantive substitution right, then there is a right to control the use of the identified asset. But very clearly it comes from the agreement that the supplier does not have a substantive substitution right, then it is clearly taken as a lease because there is a right to control the use of the asset. Say for example, a simple example is your car lease, where you enter into a lease with a lessor to lease a car, and you go in for say a specific model car, a Toyota model, and that should not be replaced by the supplier. Every time he should only send you that model car for your employees or regular on a monthly basis. So in that case, it is very clear there is no substantive substitution right, and it becomes clearly a lease. For example, you also take a warehouse on rent. You may not require the entire warehouse on rent. You may require one floor, a first floor or a second floor. And since that floor is specifically identifiable and it is specifically going to be used by the particular customer for a specified period of time, and for that particular floor, the customer, you have the right of control, then that can be identified as a lease, even though you are not taking the entire warehouse for rent.
He is giving for 1 year one model of car. Next year for our employees, I am for my employees. Another year he is doing different type of model. That cannot be counted.
You can, because the supplier has got the option or substantive substitution right. He can keep changing. You have entered into a lease with him for taking the car. And if you're clearly specifying you want only this model car which has to be given to you regularly on a month-on-month basis, then that becomes a identified asset, it becomes a lease. But if any model car he is going to give it to you, if you are not taking it, she is going to take it, then that doesn't become a lease for you. Because it is not a specifically identified asset on which you have control.
That will not come in this account.
And it will not be taken as Ind AS 116, correct? It will be like your normal operating lease where you take the car on hire, you pay whatever monthly charges which you have to pay for that operator.
It will not come in 116.
No.
Here only
Lease is where you have, as I said, a right to control on the asset for, and the asset has to be identified. It should be for a specific period of time, and there has to be a consideration which you pay. Then you have to create a ROU asset, correspondingly a liability, and then you have your depreciation and finance cost coming. So we will.
standard controls both operating and
Finance lease. No. There is no concept of operating lease as such now, because erstwhile we had that, but now it is only finance lease. So how do you identify a lease? Is there an identified asset first, explicitly or implicitly? Yes. Then these are the conditions. Is the asset explicitly or implicitly identified? Does the customer have the right to obtain substantially all the economic benefits during the period of use? Then who directs the use and for what purpose the asset is being used? Does the customer have the right to operate the asset without the supplier having a right to change? Then the customer design the asset in a way that predetermines how and for what purpose it will be used. So everything, it is a clear yes, then the contract contains a lease. Otherwise, it is not a lease. So it is very, standard is very clear on what needs to be considered for a lease and not a lease. An asset is, say, in an agreement, if it is clearly specified, okay, then say for example, in that a supplier has a fleet of vessels, okay, he owns a fleet of vessels, and only one vessel is required in that particular geographic location, and it is specifically used for those customers in those particular geographic location. Then means it is clearly identifiable. He may have a fleet of vessels, but he is specifically identifying that particular vessel which will ply in that specific geographic location. So that becomes a lease which he enters with the customer. Now, does the
not talking about transfer right in this case. That giving the option.
It will come. Transfer of title is one of the option. At the end of the lease period, if you want to purchase, then that also has to be factored in your lease rentals when it comes. So that will come in the subsequent. So does the asset need to be specified at the contract inception itself is one question. Do you clearly need to specify what is the asset at the time of the inception of the contract? Here, the key matter is whether the asset is specified at the time when it is made available to the customer. Okay, suppose there is a supplier that he may enter into an agreement to supply a drilling rig to a customer, say for a period of 6 months. So at the date of signing the contract, that supplier may have 5 drilling rigs of similar specification that could be used to fulfill the contract. So all these 5 drilling rigs are at a similar distance from the field where it is supposed to be deployed. However, the customer requires only 1 drilling rig in his oil field, okay, as per the contract. So, in this particular example, although it is not specifically mentioned that which drilling rig the customer wants, all the 5 drilling rigs are of similar specification, located at similar distance, which is available and can be given to the customer for his use. So, even though you don't identify that rig A, rig B, rig C, still this becomes a lease. Okay, so the individual drilling rig may not be specified in the agreement, but still the agreement constitutes a lease between the lessor and the lessee.
Characteristics of individual rig should be same.
Same, correct.
It will not be different.
Correct.
If it is different, it cannot be.
Cannot be. It is to be used in the same geographical area. It should be in the same distance, that and all the conditions which I told. The characteristics has to be the same. In that case, if he has similar 5 rigs, he can give 1 to the customer to use, because everything is the same. If it is different, then again there will be substantive substitution rights. When it is available, then that cannot be a lease. Then we come to how do you identify a lease? So in many cases, assets subject to the contract will normally be the entire underlying asset. So if you take a building, it will be the entire building. If you take an equipment, an entire equipment. However, as I said, a portion of the assets capacity can also be identified. As I said, a warehouse is there, but you can take 2 floors. If it is specifically identifiable, those 2 floors can be taken as a lease, as an ROU asset. So it is a portion of an asset's capacity can also be identified if the asset is physically distinct, like a floor of a building, specified strand of some fibro optic cable, or some specific segment of a pipeline. So if it is not physically distinct, but the customer has got the right to receive substantially all the capacity of the asset. For example, if it is a fiber optic cable, he has got some 80-90% of the capacity that one particular customer is only going to take. So even though it is not physically distinct, it still represents a lease. Say for example, there is a storage tank. Okay, the capacity portion in this particular example cannot be considered as a lease. We will explain why. Normally they say even a capacity portion can be considered provided it is physically distinct. So here customer D enters into an agreement with E for the right to store its gas in a specified storage tank which has no separate compartment. So there is no separate compartment, there is only one storage tank. At inception of the contract, D has storage rights that permits him to use 60% of the capacity throughout the term of the contract. E can use other 40% of the storage tank as it sees fit. So D can use only 60%, but E who is the supplier, he can use the storage tank as it, when it wants, balance 40%. E has no substitution rights. However, arrangement allows E to store gas from other customers in the same storage tank. That 60% will go to D only, but E can use the balance. He can allow other customers, because as we said, there is no separate compartments. It is only a single compartment which is there. So in this scenario, this is not an identified asset, because D has only got 60% rights of the storage tank capacity, and that capacity is not physically distinct from the balance of the tank to say that it meets the specific criteria that I'm able to identify it as a physically distinct asset.
So it is not a lease.
It's not a lease. That capacity portion cannot be identified as an asset for lease. Because you told a specific floor of a building, specific strand, you can identify it as a lease, but in this case it cannot. Then one of the question will be, does substantially all of the capacity of an asset means 90%? So here you are saying 60%. Suppose the person is able to use 90%, then can I call it as a substantial portion of the asset I have the capacity to use? The standard says it is not necessarily so. because the new standard does not define substantially all, in the term substantially all, in the context of the definition of a lease. Ind AS 116 just uses the phrase that in one of the criteria used by the lessor to determine lease classification, it only says whether the present value of lease payments, including the residual value guaranteed by the lessee or the third party, equals or exceeds substantially all of the fair value of asset. If this criteria is satisfied, then he says a substantial portion of it is, the right is there with the lessee. So there is nothing clearly coming out from the standard specifying that percentage or a threshold, saying 90% if the person is having the right, it becomes a lease. Our only criteria will be, we need to see whether the present value of lease payments, including the residual value guaranteed by the lessee, it exceeds substantially the fair value of the asset. So in that case, yes, it becomes a identified lease.
90% or 90%. Asset is not, storage place is not identified. So even in case of 90%, we are
Not.
now it cannot be done.
Correct. Because first itself it is not there. Specifically, it is not clearly identifiable. Then how do we separate a lease component and a non-lease component? This is a common thing. Everywhere we see a lease as well as non-lease components will be there in the agreement. So one thing is, from the a lessee or a lessor shall account for each separate lease component with a contract as a lease separately from non-lease component of the contract, unless the lessee applies the practical expedient. So if separate, you call it as a separate lease component if the lessee can benefit from the use of the leased asset or together with other resources that are readily available, and the underlying asset is neither highly dependent on or highly interrelated with other leased assets in the contract. So to put it in very, very simple, this is the accounting way of telling, but how do we see whether it is a lease component or a non-lease component? Say suppose you take building on rent and you have your utilities and maintenance, which is also included as part of your rent. The rent cost will alone be included in the lease, your main rent which you pay for the building. Whereas this utilities and maintenance cost, you can consider them as a non-lease component and you can keep charging them off. Since the maintenance expenses, you can separately identify them as part of the agreement and it need not be combined with rent. Your rent is a portion which you pay for the particular usage of that square feet area or something. Maintenance and utilities is something which is separately identifiable, that is also clearly given in your agreement. Then you can bifurcate as a non-lease component, and that maintenance and utilities you can charge it off. They're similar. Huh?
Maintenance charges is non-lease.
Yeah. Rent alone will be lease, which you take it as an ROU asset if when you identified it as a lease. Maintenance and utilities, you can take it as a non-lease. There are further slide which is coming. If my maintenance and utility is not clearly coming out in the agreement, then how do I arrive at the proportion to see what is a non-lease component that I may have to take out? Parking, another example is your parking, cost. If it is separately given in the agreement, clearly saying that for this particular area, this will be the parking cost which is incurred to be incurred every month, then that can also be considered as a non-lease component. It need not be added with your rent as part of a ROU asset.
Is it optional or mandatory? Has to be removed from the lease or it can be your
No, it has, actually if there is a non-lease component, you have to identify it and remove it from the lease. If it is clearly coming out in the agreement. Where you are not able to identify the non-lease component, then it is considered as a lease component and taken as an ROU asset. Otherwise you have to do, unless and otherwise the lessee exercises the practical expedient clause. If he says that he is not taking it because it is a short term, I am not considering the non-lease component, then it is allowed. Otherwise you have to identify the non-lease component. Right of use. Right of use. Here where I told if the agreement clearly specifies like utilities and maintenance, if parking, separately it is there means it is easy for us to identify. But if it is not given, then how do I identify my non-lease component is the formula that is given. But if I give it to you in a simple example, say for example, normally 100 rupees is going to be the rent, okay, including maintenance, normal. But if I go to the market, I'm going for say taking another building or something on rent, I have to pay 30 rupees as my maintenance, okay. I will have to pay 30 rupees as maintenance and 80 rupees as rent. So that is split in the market. When I go for another building, they say 80 pay rent, 30 pay maintenance. So in that case, how I will apportion is 100 rupees was the original, whatever the rent I am paying, including maintenance. Now it will be 100 into 30 by 110. So this is the way I will apportion my non-lease component. If I am not clearly able to identify the amount in the agreement. Say it is my rent is inclusive of this maintenance and it is not clear, but unless and otherwise it clearly comes out, it is not required to take it out separately using this formula. But if there is a trend, various agreements are entered into by the company where this is the manner in which they are identifying the non-lease component, then that can be followed. No, this is based on your agreements which you kept entering. That company kept entering various agreements, and basis that this was the rent that they had, this was the maintenance cost that they were paying for various other places. So you can take it based on that, based on the various other similar agreements entered into by the company with various lessors. So that is how we determine. So some FAQs are common area maintenance services a non-lease component. So which we saw, maintenance of building and all, whether it is a non-lease component, yes, it has to be identified as a separate non-lease component. Can a lessee combine a lease component with a significant non-lease component? So the standard does not prohibit a lessee from combining a small lease component with a significant non-lease components. However, it is not acceptable for a lessee to combine a very small with a very large unrelated contract. So now, mostly what will be done is non-lease component, if it is identified, it is taken out an expense, and your lease component only is considered for your ROU for a better accounting. Can a lessor apply this practical expedient? Only lessee has the option of practical expedient, which we will cover in the other slide. Lessor cannot exercise practical expedient. Can a lessee choose to apply this exemption on an asset by asset basis? The practical expedient of combining lease and non-lease components can be done only for a class of assets. What do I mean by class of assets? Suppose there are 10 furniture and fixtures. Okay, this has to be applied for that all 10 contracts for furniture and fixtures. It cannot be applied for one furniture and fixture in that class of assets. So when you are taking the practical expedient, it should be for the class of assets and not for line by line single asset.
Class of assets may be only agreement or different?
Huh? Class of assets is in your fixed assets. It can be furnitures, it can be computers, it can be office equipments. Under that you may have 100 items or 10 items. So that has to be applied for that entire block of assets, not one or two line items within that category. So here, how do we identify standalone selling prices? Where a lessor R leases a specialized machine for 2 years to lessee L and provides consulting services to help L use the machine effectively in its production process. Machine is not sold or leased separately by R, and there are no similar machines for sale or lease from other suppliers also. So the consideration is 1 lakh for the first year, 80,000 for the second year. R priced the contract in this way, assuming that it will provide more consulting service in the first year itself. Now, R allocates the consideration using estimated standalone selling price because it does not provide the machine or any consulting services separately because it is told in the above para. R will estimate the standalone selling price as follows. There are no similar machines for lease by other suppliers. So R uses your cost plus a margin to arrive at a standalone selling price of 1,60,000 because consideration is 1 lakh and there are no other suppliers of this. There is one cost plus markup. So he says the machine lease will be at 1,60,000. Then he says there is some consulting service cost which is also 40,000. So totally my standalone price is 2. So 1,60,000 on 2 lakh, 80%, he will on that 1,80,000, which is my first year consideration plus second year. So that he will allocate it towards machine lease, and 20%, 40 by 2 lakh, 20% of 1,80,000, I will split it to consulting services. So this is on estimating your selling price where I have a machine lease and a consulting service happening. How do I apportion the cost between the machine cost and the consulting services? Because both is being rendered by this lessor R. Is there a possibility that L accounts it as a lessee whereas R will account it as a normal income? Possibility where? Introspecting as an asset. How ROU you get when L is booked, whereas R may use opposite accounting. No, but if I am taking it as an ROU, then the other person has to account it in the similar manner only. How that is, for him it is not going to be an ROU. It is either going to be an expense or an income. From the lessor's point of view only, it is going to be a ROU, or whether I am going to treat it as a normal expense. Tell me, sir. 40,000 divided by 2 lakh gives me 20%. So 20% I apply on the consideration for the first and second year to allocate. So next important thing is the lease term. So at the commencement date, your estimated lease term will be your non-cancellable period of the lease plus any period covered by the option to extend the lease. If you have the option to extend the lease, that also has to be considered, and that is reasonably certain. I have a reasonable certainty that that extension is exercisable, plus period covered by the option to terminate the lease if the lessee is not reasonably certain not to exercise it. So all this I have to factor in to arrive at my estimated lease term. And the entity must determine the period for which the contract is also totally enforceable. So, for example, there might be a penalty which you need to pay. And suppose you want to exit or you want to terminate or something, the penalty clause may be not a significant amount. But still, if you are going to exit the contract, it may, say for example, impact the continuity of your operations itself. In that case, you should also assess the impact of the termination of the lease, although the penalty amount which is specified in the agreement may not be significant. So you have to evaluate both the economic assessment as well as the legal assessment. You have to consider the broader economics of the contract. Even though you say the penalty is only 2 lakhs if I exit the contract, but it is very critical that the particular whatever the machine or the place which is taken on lease, if you're going to vacate or if you're going to terminate it, it is going to impact the continuity of your operations, and that also has to be considered in estimating the lease term. If a lessor can cancel the lease, does this affect the non-cancellable period? If only the lessor has the right to terminate a lease, then the non-cancellable period of the lease includes the period covered by the lessor's option to terminate the lease. In this situation, lessee has an unconditional obligation to pay for the right to use the asset for the period of the lease, unless and until the lessor decides to terminate the lease. So any non-cancellable period or notice period in a lease would meet the definition of a contract and be included as part of the lease term. So here they are saying only if the lessor has got the option to cancel the lease. The lessee does not have the option. But lessor has an option. The lessee has an unconditional obligation to pay for the right for use of the asset. Then you cannot, it will not affect the non-cancellable period. Do notice periods affect the non-cancelable period? Yes, because you have to, if you're going to terminate the contract, you have to give, a 3 months or 2 months, whatever period that you are going to vacate the premises. So in that case, it will impact the non-cancelable period. Does a contingent termination provision in lease affect the non-cancelable period? Even a contingent termination provision also affects the non-cancelable period if it is within the lessee's control. Then in that case, the right is assessed in the same way as a non-contingent termination right. Therefore, it will affect the non-cancelable period. So what are we trying to tell is the likelihood of the triggering event if occurring is more than remote, then it will affect the non-cancelable period if it is bound to happen. So some factors which we need to consider when we are assessing the lease term. So if I am saying, first we are saying non-cancelable period has to be considered, then in what circumstances will a non-cancelable period be impacted or not impacted? Lesser, because it's everything from the concept of the lesser. This is another important, the enforceable period in the lease term, as we see, is split into three: a lease commencement, minimum lease term, and maximum lease term. So, where we are entering into a contract, say, for 5 years, with an option to extend the contracts for 1 more year. So, as per the agreement, your non-cancelable period is 5 years. As per the initial agreement, where I have it for 5 years, plus I can extend it for 1 more year, means your non-cancelable period is 5 years. Plus, if I also have an enforceable option, the second blue one, to extend for another 5 years. Okay, then so we need to evaluate the enforceable option and see if it has to be included as a lease term, which is a 10-year period at the lease commencement itself. So that is what we are trying to tell here. So where you are entering into a contract and where you have an option to extend the contract, and you have entered into a 5 years contract having an enforceable option, then we need to see whether you need to factor that as part of the lease term and consider a 10-year period at the commencement of the lease itself.
Whether it is there or you have to go by case by case?
Case by case, yes. Agreement, basis the agreement. Then for each of the lease that is entered into, we have to reassess the lease term also, which is, we have to reassess the lease term, which is also very critical. So a lessee should reassess whether they are reasonably certain to exercise extension or not exercise termination option when a significant event happens, or there is a significant change in the circumstances that is within the control of the lessee. So why we are saying is, if there are any terminations, if there are any extensions, it is going to impact your lease term and your payments, your discount rate, everything. So it is very, very critical that you assess your lease term at the inception of the lease correctly, and you evaluate it also regularly. You reassess if there are any terminations or modifications happening to the lease. Say for example, standard allows us to reassess the lease term. For example, what happened during COVID, say when there are changes in the option of the lease, especially after COVID, whether you need to extend or whether you need to renew the particular option, then there becomes a significant change in the circumstances of the lease, and then you have to remeasure what is going to be your lease term, what is going to be your revised discount rate, and that depends on again the date of commencement and period of the lease, basis on the significant change that has happened. So we know because of COVID, lot of changes had happened, modification, leases got restructured also. So all that impact had to be considered in your, as part of your rental payments as well as your discount rate, because your IRR, the internal rate of return, underwent a change. So because of which the initial definition will undergo a change. Correct.
suppose say 11 months, whether it can provide a lease agreement for 10% increase in the original agreement, is it valid?
Year on year, not year on year, 3 years once, where there will be a 10% increase if it is provided in the agreement, and it is certain that you will renew the lease every 3 years, then we can take that increment. So again, as I said, you have to evaluate like whether it is the agreement can say it will be renewed every 3 years. Whether it is cancelable, then it cannot be considered. It is non-cancelable lease, you can consider that increment and then start including it as part of your ROU asset. In the other cases where it is certain that say for the company has continuingly renewed the agreement for 3 years, 3 years, 3 years, now this is the 12th year, it is very clear that the company is not going to come out of that agreement. So obviously you can consider the 10% and the escalation can be considered regularly. Lease accounting, where we will cover from a lessee perspective and a lessor perspective. So lessee accounting, an entity that obtains the right to use an underlying asset for a period of time in exchange for consideration. So the lessee is a person who is going to use the underlying asset for a period of time in exchange for consideration. So you will have lease payments. So for the asset which the lessee is taking, he will have to make payments made by a lessee to a lessor relating to the right to use an underlying asset during the lease term. So it will comprise of fixed payments, variable payments. You exercise your price of a purchase option. This is what we told, if a lessee is reasonably certain to exercise that option at the end of the lease. Payments, penalties, terminating clause, if the lease term reflects the lessee exercising an option to terminate the lease. So your payments should factor in all these, the payments by the lease payments. Then unguaranteed residual value is that portion of the underlying asset, the realization of which by a lessor is not assured or is guaranteed solely by a party related to a lessor. That is, what is the value that he will get at the time of sale of the asset, minimum guarantee value. That has to be reduced from the value of the asset when you determine your lease. Right of use asset represents a lessee's right to use an underlying asset for the lease term. Underlying asset is the asset that is subject of a lease for which the lessee has got the right to use, that is provided by the lessor. Then initial direct cost is nothing but incremental costs of obtaining a lease that would not have been incurred if the lease had not been obtained. So what we are trying to say is these are all the various accounting parlance in the lessee accounting, where you have to see the lease payments, how the lease payments have to be arrived at, which comprises of fixed, variable, where at the exercise of purchase option, how he has to factor it in the lease payments, penalties or terminating clause, if any, he has to factor in. Then your unguaranteed residual value, your initial direct costs.
Lease payments is a revenue expenditure. Lease payments. That exercise our purchase option at the end of the lease, that is a capital expenditure.
No, the entire thing from Ind AS 116 is where you are going to take it as an ROU asset and you are going to take it as a lease liability. There will be a corresponding asset which is created and a lease liability. So when you are determining what is the value at which you have to capitalize your right of use asset, you have to consider these also. If you have an option to purchase at the end of the lease, then at what price you have to now capitalize the leased asset in your books. That is what they are trying to tell.
This is a revenue expenditure. Lease payments is shown as a revenue expenditure in terms of this. Every year P&L account debited?
No, it will go as a asset, it will go as a depreciation, then it will get amortized, and then you have a corresponding liability, and adukku what is the finance cost, that will go as a finance cost in my P&L. So basically you will have an asset which is getting amortized, you will have a liability, corresponding liability, and whatever is the interest cost on finance cost, which will come in your P&L. So two items in your P&L will be depreciation and finance cost for the particular lease asset.
Finance cost. Who debits will come?
Yeah. So at the lessee accounting, at the commencement date, the lease liability and ROU asset in the books of the lessee are determined using a number of inputs. So when I come to, as I said, you have a ROU asset, return of use asset, and you have a lease liability. Lease liability is nothing but your regular fixed rental payments which you will keep making. From there, any incentives which you receive from the lessor, like any discounts or any other incentives which you are receiving, plus variable payments, like because of any index rate change, any changes in your consumer price index, that will get added. Residual value guarantee, which I said at the end of the lease period, where this is the minimum price you will get on the sale of the particular asset, that also you have to add. Then where you exercise your purchase option, what will be the impact of that, and termination penalty. So all that to be added, and then you will arrive at your lease liability on the liability side. This has to be discounted. Basically all this has to be discounted over the lease term. So to discount this, you will use the incremental borrowing rate. You will have a corresponding ROU asset, which is nothing but your lease liability comprising of all these, plus any cost of dismantling or removing the asset, plus any lease payments which you have already paid minus incentive received and initial direct cost. So this will be your ROU asset. So ROU asset you will create, you will amortize it through depreciation, and this will be your lease liability, for which there will be a finance cost also coming.
This lease liability is shown under current liabilities.
Yes, it separately it is shown as a separate line item in your balance sheet. It's not grouped on the face of the balance sheet itself, it's there. Line item. No, under assets, you have fixed assets, you will have CWIP, intangibles, like that one line item will be right of use assets. Liability same way. You have like equity, you have borrowings, you have deferred tax, like that you will have lease liability as a separate line, borrowings, like that separate line item you will have lease liability.
We analyze the balance sheet. Suppose total outside liabilities plus tangible net worth. It will consider liability or net worth? This lease liability.
It is liability.
Outside liabilities.
I don't understand what is outside. Huh?
As equity or outside?
No, liabilities. Yeah. So here, lessee may use one of the following exemptions, in which case an ROU asset and lease liability need not be recognized. So what are the cases where the lessee can opt for? Straight away, when it is a short-term lease, where your lease period is less than 12 months, then, and it is not applicable to leases which has got a purchase option. At the end of 1 year, I'm going to buy it, or there is no lease at all, but straight away I'm entering into a purchase agreement, it will not even happen. Then if he has to apply this, what to say, practical expedient, it has to be for all the entire asset class. Okay, then lease payments are recognized as an expense on either a straight line basis or over the lease term or any other systematic basis. So two things where the lessee can opt for the exemption, where he need not account it as an ROU asset and lease liability, is where in case of a short term lease, and if the underlying asset is of a very low value. 12 months less, straight.
12 months, maximum 12 months.
Yes. And this short-term lease exemption, you have to take it at the time of commencement of the lease, not at the time when it is, you are getting into modification. Okay, and say, as I said, if there are 10 contracts for furnitures and fixture, it has to be applied for the entire class of assets and not for single transaction. So that is not allowed. You have to holistically view the particular class of asset.
Asset liability you show, whether both should match.
It will almost, sir, but at the end of the lease period, it will become zero. It will not pie to pie match. It will not match. Your ROU asset and our ROU liability will not be same. You are saying if I have 1,000 as ROU, will I have 1,000 as ROU liability? It will not be that. But at the end of the lease period, it will become zero. So Say for example, there are some manufacturing type of leases also where you apply the short-term lease exemption. When do you avail this exemption? Say lessee L enters into a 10-year lease of a machine to be used in manufacturing parts for a plane. It expects the model of plane to remain popular with customers until it completes development and testing. The cost to install the machine in L's manufacturing facility is not significant. L and lessor M each have the right to terminate the lease. Both of them have the right to terminate the lease without a penalty on each anniversary of the lease commencement date, which means every year only it will be actually valid. Post that, both of them will have the right to terminate the lease without penalty. Although the contract is for 10 years, as we saw above, the non-cancellable period is 1 year. Because both L and M have substantive termination right and both can terminate the lease without any penalty, and the cost to install the machine in L's facility is also not significant. So what happens? The lease term is 1 year and so it qualifies for a short-term lease. Okay. Second is where there is a lease modification or change in the lease term. Say lessee S enters into a contract with T to lease a non-specialized equipment for 12 months for some construction work. The contract includes 2 12-month renewal option with no change in payments, and you don't have a purchase option at the end of the lease. At lease commencement, S determines that it is not reasonably certain to exercise the renewal option. Considering all the relevant economic factors, this is because S expects to complete its construction work within the first 12 months. So S concludes that the lease term will be only for 12 months. In that case, even though the contract includes 2 12-month renewal, because S is saying it will complete the work within 12 months, it is concluded to be a short-term lease because the lease term is no longer than 12 months and there is no purchase option in the contract. So S will elect to apply, the lessee will elect to apply the short-term exemption to all short-term leases of assets within that same class of asset. In applying the short-term lease, S will recognize the lease payment as a leased cost. So it becomes an expense, direct expense for you and not as a lease. It does not come as a ROU asset and a lease liability in your balance sheet.
Straight away you will have to pay.
P&L.
Short-term lease also like that.
All short-term leases straight debit to P&L. Normal rent, like your rental expense.
No finance cost.
The meeting is available in the institute, right?
I have not yet shared to the institute. Post this session, I will share it to them.
I will leave now.
Okay. I will share it, sir. I will anyway share it to the institute. Short-term lease that no longer meets the definition after modification or change in a lease term. So initially you told it as a short term, but then post modification there is a change in the lease term. So continuing the same example which we saw in that contract lessor S and lessor T, 10 months after entering into lease, S expands the scope and duration of the construction at its factory. So it is now expecting that it will have an ongoing need to use the equipment throughout the second year, and market prices have increased such that S has an economic incentive to extend the existing lease rather than enter into a new lease. So S therefore gives binding notice that it will exercise its option to extend the lease for more than 12 months. So as there is a change in the lease term, so S will account this as a new lease. And now the new lease term will be what? 10 months has expired in the old. So that is gone as an expense. Now for next 12 months plus 2 months from the old term, you will enter into a new lease term for 14 months. And this does not meet your short-term definition. So it will be considered as a lease. So that is where we are saying, where earlier it was taken as a short term, because of the modification in the terms, you are now recognizing it as a ROU asset. Correct. Because 10 you have taken off, 2 you are going to extend plus 14.
Operating lease. Short-term lease can be called as operating lease.
Yeah, yes,
It can be treated like account
correct,
regular account
regular.
for even for companies where the India is applicable.
If it is short term, expense. So in the books of the lessee, the lease liability, your initial measurement and your lease payments, if you see, earlier we saw in the slides fixed payment, which will include a fixed contract, as per the contract, periodic payments which you have to make. Then you will have your lease incentives or receivables, which is the benefit which you receive from the lessor in the form of a discount or some concession, plus variable lease payments. The variable lease payments is where you have your consumer price index and others coming into place, inflation, which will change your variable lease payments. Then residual guarantee, where he should estimate the amount that it expects to pay to the lessor at the end of the lease, where he expects this will be my minimum residual guarantee value. And purchase option, if it is there, that also has to be added with your lease payment, plus payment of termination penalty. So what all we saw in the previous slide is what I'm trying to put it here, like what your lease liability will comprise of.
This is useful for calculating
The lease payment. We saw in the previous slide here, this one, for your lease liability.
interest rate calculation.
What is your lease liability which you need to discount using your incremental borrowing rate? So the amount which you should recognize as your liability. So now we are going to look at the residual value. We saw in the previous slides residual value guarantee. So with an example, maybe if I say, you will understand. So lessee Z has entered into a lease contract with L to lease a car. The term is 5 years. In addition to that, Z and L agree that there will be a residual value guarantee. If the fair value of the car at the end of the lease term is below 400, then Z will pay to L an amount equal to the difference between 400 and the fair value of the car. This they agree at the time of entering into the lease itself. So at the commencement of the lease, Z expects the fair value of the car at the end of the lease term to be 400. So what he will do? He will include an amount of, he will not include any adjustment in the lease payments. Z therefore includes an amount of 0 in the lease payments when he is calculating the lease liability. Suppose subsequently Z monitors the expected fair value of the car at the end of the lease term, and if the expected fair value falls below 400, then is the point where Z will remeasure the lease liability to see what is the amount it has to include, the amount expected to be payable under the residual value guarantee using your unchanged discount rate. So when it is, if it is nothing is to be considered, he will take it as 0 when he is computing the lease payment, but if there is something to be adjusted, that has to be adjusted as part of lease payment. Now itself and adjusted. Lessee purchase option. This is the one where the lessee has an option of purchasing. So you assess if reasonably certain again. So this also you have to adjust it as part of your lease payments when you have a purchase option. Say lessee E enters into a non-cancellable 5-year lease with R to use an equipment. There is no renewal option, but E has the option to purchase at the end of the lease for rupees 500. Because this piece of equipment is used in some technology, the fair value of the equipment at the end of the lease is subject to significant volatility, and it estimates to range from 400 to 900. And the duration of the non-cancellable period is 5 years. So, for example, newer or better alternative assets may be introduced during the 5-year lease term. E also makes an overall assessment of whether it has an economic incentive to exercise the purchase option at the end of the lease and concludes that it is not reasonably certain to do so. So this includes E's assessment of significant volatility in the future fair value of the equipment and at the end of the lease, and the probability that better alternative assets may be introduced during the period. So assessing whether E is reasonably certain to exercise the option can involve significant judgment. A shorter term or a different environment could lead to a different conclusion. So basis various parameters, if the lessee exercises the option to purchase Accordingly, in the lease payment, just as how you are giving impact to your residual value guarantee, this also has to be given effect to. But he says it is basis, case to case basis, historically basis on what is the market condition, everything will lead to a different conclusion.
This case, actually, right to purchase, that can be exercised by lessee.
Lessee, correct.
This treatment is, you are talking about
Lessee. So, another important thing is where the standard focuses on substantive substitution rights, where we said that the supplier should not have any substantive substitution rights. Like the supplier has to supply only the specified goods to the customer as requested by him, only then it can be a lease. So, the example where we are telling in case of a motor vehicle, customer S enters into a contract with T for the right to use a vehicle for 5 years. Now, T has the right to substitute the asset at any time after 3 years from the commencement of the contract. That is, no substitution right is available for the first 3 years, but after that he can substitute. Because the supplier's substitution right does not apply throughout the period of use, it is not substantive. So, it is only for the first 3 years he will not be able to substitute, but rest after that he will be able to substitute, and it does not apply throughout the period. So, it is not considered to be substantive substitution rights. Therefore, it is lease, because if he is able to influence throughout the period, then that is something different. The second scenario is the contract is the same as above, except that it gives T the right to substitute the identified asset on a single date, 3 years into the lease, but not at any other time. The substitution right is not substantive because it is only for 1 day in the 3 years where he is allowed to change that particular asset. Then it does not mean a substantive substitution has happened. It still continues to be a lease. The contract is as above, but T has a right to substitute on the occurrence of a particular event. Substitution right is not substantive because it does not apply throughout the period of use, but only on the occurrence. So, where it is very, very clearly identified, it is only because of a particular event, or it is only in a single day, or it is like not covering the entire period of the lease consistently, then in that case, you can say that there is no substantive substitution rights and it is a lease.
We are talking about legal side agreements. We will scrutinize the agreement and come to a conclusion. That will be made by lawyer only.
Basis what agreement it is there, we have to come to a conclusion. And another thing is also on the facts and circumstances, that is what they say, the intention of the company, how they want to go about, what are they doing historically, and whether it is in line with whatever we are interpreting from the agreement. So, all that is there.
Because the person who makes the agreements, at that time they would not have consulted us.
Definitely.
We will go for audit only, everything over only for this. So, correct.
Correct. So, when we come across, then we have to at least keep our clients informed that there is so many things in this. So, when you're going for a renewal, when you're going for a modification, or when you're going for a new agreement with another lessor, please factor all this. As you said, a lot of agreements are old agreements which will keep on continuing and renewed, but still. Certain things we will not even revisit, because old agreements which keep continuing, we will take it as it is, like, okay, this is a lease only and we will keep on going. But actually when you see the agreement, it will be something different when they have entered it now. Or short term, which we don't even know it is a short term, we would have taken it as an ROU asset, or vice versa, which has to be taken as short term will be there. So, lot many, as you said, each and every agreement has to be read.
We will not consult a charter owner while making agreement.
That is there, but once we identify something, at least we have to inform the management to take care of these aspects. So, what if the customer has the right to use the underlying asset for non-consecutive periods? Say there is an arrangement to use an identified asset. It would meet the definition of a lease if it contains intermittent periods during which the customer does not have the right to control the use of asset. Say for example, there is a football team which has the exclusive right to use a specific stadium for the months of September to May each year, and the contract runs for 10 years. And from June to August, the owner of the stadium holds concerts and other events in that particular stadium. So in this situation, the period of use consists of 90 consecutive months. Why? Because we can use the stadium for 9 months each year over the 10-year contract. So the use of the same stadium by the owner in the remaining months of the year does not prevent the contract from being a lease, provided that the other aspects of the definition are met. So from the agreement, at least for the period September to May, it is specifically available only for that particular lessee to conduct whatever football tournament it has to conduct. And for the other period, the lessor is using it for other activities. Still, it is considered as a lease, provided all other aspects of the definition is also being met. Lessee.
So lessee can use for any purpose.
No, you can call it as a lease in the books of the lessee if, as per the agreement, like if it is a 10-year contract, but for the 9 months you are able to use it for your particular purpose to conduct that football event or something, and balance 3 months the lessor is using for some other activities. In the books of the lessee, you can consider it as a lease still. Even if for the 3 months, because according to you, you are having the exclusive right to use the stadium for the 9 months. He is allowing you to use it exclusively for full 9 months for your purpose, and you don't want it for the other months because it is not a playing season. So for the 9 months, for the 10 years period, so 90 consecutive months is what you want. So that is considered as a lease, and you will have an ROU asset in your books. Lessee. So customer takes the how and for what purpose decisions. Say for example, customer T, he enters into a 5-year contract with a supplier U. The supplier is a ship owner for the use of an identified ship. T decides whether and what cargo will be transported. T is the lessee, basically. T decides whether and what cargo will be transported and when and to which port the ship will sail through the period of use, subject to any restrictions which is specified in the contract. These restrictions prevent T from sailing the ship into waters at a high risk of piracy or carrying explosive materials as cargo. You, the supplier, operates and maintains the ship and is responsible for the safe passage. Now, T has the right to direct the use of the ship. The contractual restrictions are protective rights, like it should not carry any explosives, or it should not sail in other geography because of piracy reasons. The contractual restrictions are protective rights that protect you, who's the lessor's investment in the ship and its people. In the scope of its right of use, T determines how and for what purpose the ship is used throughout the 5-year period, because it decides whether, where and when the ship sails, as well as deciding the cargo that it will transport. So T has the right to change these decisions throughout the period of use. So basically the lessee has got the influence on what has to be done with that particular arrangement.
In this case, lease or
Lease. Yes. Because lessee has got the control over the use of that asset for the identified period. This is nothing. Lease liability initial measurement. So which we spoke about, what is the value at which the lease liability has to be recorded in the balance sheet. So whatever lease liability is identified, you discount it using your incremental borrowing rate. So that the present value of lease payments and unguaranteed residual value is equal to the fair value of the assets plus your initial direct cost. So you have a formula for all calculating your incremental borrowing rate. So normally the government bond with the same term as the lease term can be used to compute your incremental borrowing rate. So much of it depends on how your payment is getting structured, whether it is a monthly payment or a one-time payment, or what is the type of the asset, whether it is a building lease or a vehicle lease, so everything will determine what is the type of payment and how your incremental borrowing rate is being computed. Normally, it will be specified in the agreement. If it comes straight away in the agreement, that is your IRR, internal rate of return. But not all agreements are very clear, so we generally go by incremental borrowing rate.
Suppose the fixed assets of lessor is financed by bank or the rate of interest which bank has given, that rate we can apply here.
No, that is lesser. That is what we say, now government bond with the same lease term, that can be used for the purpose of computing the discount rate for the lessee.
Assuming there are various leases across various periods of time and the lessee has actually got incremental borrowings under various type of instruments. So will that not a weighted average we can be used? Incremental borrowing.
Your incremental borrowing as far as the lessee, if he has various borrowing rates which is there, normally we will take in the government bond rate only, just as how you use that same for your actuarial valuation and all. We don't go by the various bank rates which he has. It will only be the government bond rates which we do. But I am
Bond is typically for like a 10-year G-Sec.
correct.
Whereas this may not be equal to a
10-year, correct. But normally we go with this. I have not come across instance where we take a bank thing, but I may get back on that. I'm not too clear on whether a bank rate can be used. Bank borrowing rate can be considered. In days, it is normally we go up by the government bond rate, which is more, clear in most of the valuations that we do. Even as I said, for actuarial assumptions and all, we go with the bond rate for that increment and other things, the inflation and other things and all. So here also we go that way, but I can check on this for the banks whether that rate can be taken. So in the books of the lessee, your lease liability, as we said, and your right of use, you have either your cost model, your fair value model, or your revaluation model. So when I say lease liability, initial cost, interest minus lease payments, measurements, and lease modifications, and ROU can be either one of the model.
ROE is classified as fixed assets.
Separate line item in the balance sheet. Again, when we talk about revaluation, if I say the revaluation can only be done it can be only block specific, it cannot be asset specific. For the entire block, you need to revalue it.
Suppose we calculate the ratio return on assets. This we will take this
Return on assets in the sense.
profit after tax the assets. You take this, what is that?
Right of use asset. Return on assets is, you say current assets by current liabilities, or what you are going to? Total assets it will come. Because it is there as part of your balance sheet, all other assets, total assets, this will also come as part of total assets. But if you take only your current assets and current liabilities, this will not come. Because it doesn't get classified under current assets and current liability.
It is not classified. Actually, asset is also not owned by this. It is not after
Right to use, correct.
But how that formula will have, we cannot use that return on assets. Fixed assets plus current assets. It will get reduced. Like
In your numerator and denominator, that impact will anyways be there.
You will be making monthly or annual payments. So liability is going to increase.
So in case of cost model or a revaluation model, when does, based on the commencement date, the depreciation, the amortization starts. So does the lease transfer ownership of the underlying asset to the lessee by the end of the lease term? Then at the end of the useful life of the underlying asset. If it does not, then does the cost of the right of use asset reflect that the lessee will exercise a purchase option? If there is a purchase option, then again till the end of the useful life of the underlying asset, the amortization will happen. Otherwise, earlier of the use of the ROU asset or the lease term. So here the lease liability subsequent measurement, where you have your the carrying amount plus your interest on lease liability, your lease payments plus or minus any reassessment, lease modifications, and your foreign currency remeasurements. So if there is say interest on lease liability in each period during the lease term, there is a constant periodic rate of interest on the lease liability, which is, as I said, goes as your finance cost in your P&L. Your lease payments, the variable lease payments that are not included in the measurement of lease liability, that will go to P&L, otherwise it will be part of your lease liability only. Lease modifications, if it is because of the increased scope, then it goes as part of your lease liability. And foreign currency measurements, because it is only a change in the leases which are denominated in foreign currency, because of the valuation, you have these foreign currency remeasurements because of closing rate differences, that gets recognized in your P&L like a normal foreign currency gain or loss. So, say for cases where you have to consider it as a separate lease or whether it is a modification of the original contract. Say you have already taken a floor on lease, say 1,000 rupees a floor on lease, and you are entering into a lease contract with the same lessor, and because you have already taken the first floor, he is giving the second floor at a little concession rate, say at 800. Then what happens is, this is a modification, this can be considered as a modification to the original contract, where you have taken a floor for 1,000 and the second floor also is coming for 1,000 rupees. You are not exercising the benefit of taking the first floor. Then the second floor will be taken as a separate lease contract, not as a modification to the original lease contract. It basically it will not be linked. Because in case you are taking a floor and then because of which you are able to get a reduced rate for another floor, then you can say as a modification to the contract and consider that. But same lease, a modification. But you need, otherwise it will be taken as a separate lease. So lease liability and ROU asset subsequent measurement. So you determine the discount rate based on your payment change, because if their payment change may happen because there is a change in the lease term, because at the end of the lease there is a purchase option, because of residual value guarantee, or because of the consumer price index change. So all this may result in revision in your lease payments. So the interest rate will also be revised based on your revised lease term, and this has to be, the incremental borrowing rate has to be assessed at the specific date of change. So every time what we are trying to tell is, one is not going to be fixed right from the inception of the lease till the end. So evaluation has to happen at every period. Remeasurement of your asset and liability has to happen. It can't keep on changing very frequently, but if there are changes or modifications in the lease term, which I said, or if there is some residual value guarantee which is coming in, or variable expenses are changing because of your CPI, then your incremental borrowing rate will change.
That should be disclosed.
And it need not be separately disclosed. That will be factored in, and anyways as part of disclosure you will be showing all your the lease liability, that will come separately as a disclosure. So this need not be separately shown. Because of this there is a change in the discount rate, need not be shown. Again, a change in the scope of a lease or consideration for the lease that was not part of the original terms and conditions of the lease, that becomes a lease modification. It was not earlier part of the original lease, but something has happened or changed which has resulted in the modification. It becomes a modification to the original lease, and the effective date of modification will be the date on which the lease is modified and where both the parties agree to that modification. So if there is any modification to the lease, it increases the scope by adding the right to use one or more underlying asset. Because of your modification, your consideration also increases in proportion with the standalone price. Then you assess whether it is a separate lease, whether the modification has to be taken as in the original lease or whether it has to be considered as a separate new lease. And then basis that you will determine what is your payments, your discount term and your lease term. If it is not a separate lease, then at the effective date of modification, then you have to allocate what is the consideration. For reduction of lease scope only, the reduced space or the reduced lease term, reduced ROU asset, that only has to be considered. And for all modifications, you have to remeasure your lease liability, and then adjustment of the ROU asset and the lease liability is adjusted against the ROU asset. So one, either whether you have to take it as a separate lease or whether you have to take it as a modification, and how you have to account it as part of ROU and liability.
After calculating ROU, then only we will calculate.
It is, yeah, the same, when you compute the ROU, at the same time itself, the liability also will be determined. This is
Lease term, the asset becomes useless.
before determination of?
The lease period, the asset becomes of no use to you. What do you do? Net it off and hit the P&L.
In which circumstance will that? Because normally it will be a 5-year, you will extend or renew. So at the end of 5 years, if you feel that it is...
You're taking that asset for a particular purpose. It ceases to be useful for that purpose.
It ceases to be useless, you cannot use it beyond that.
So then you just set off the asset against the liability and balance.
Completely you will terminate it because it is not at all usable and it is, you are closing, winding, then it has to be taken out of your balance sheet only.
And you will have to debit the P&L.
Already normally,
The ROU value is going to be higher than this.
correct.
So the difference will have to be debited. Will it be an impairment or will it be a loss on right of use? Because I don't think it's not a fixed asset.
It will be a loss only, I don't think so, an impairment will come, it will be a loss. But that is a very, very remote scenario where you will end up not using the asset for the specified period. But if at all something unforeseen circumstance happens, you have to move out of it, then it will be, you have to close it, you have to remove it from your balance sheet and take it at a loss. For the remaining, because anyways, say for 3, if it is for 5 years, up to 2 or 3 years, you would have anyways done the depreciation and finance cost. For the remaining period, you have to take it as a loss.
Why loss, like if the asset is not, I cannot use, I'm not going to pay the lease rental to the asset.
No, you cannot use it without paying the lease rental, no.
Yeah, I'll have the asset and I'll have the liability. I have to write off the asset also will go, liability also will go. So no much impact. To the
Correct. Both ways, because you will remove the asset, you will also remove the liability. Impact will be there in the P&L. Not a major impact because you are anyways having an asset and a corresponding liability in that.
What about finance cost?
Hmm?
Finance cost. How to calculate finance cost?
Interest expense, there it is there, the profit and loss. In interest expense on lease liability. So in the lessee, in the books of the lessee, in your balance sheet, you will have ROU asset, lease liability and payable for short term and low value leases. So ROU asset, it is separate, your question, from PPE assets. Then in the profit and loss, if you see your variable lease payments, normal variable lease payments, not in your liability. If it is there as part of ROU lease liability, it will not be in your P&L. So variable lease payments not in liability, short term low value assets. If it is short term as well as low value assets, your interest expense on lease liability, that will go as a finance cost. Your depreciation, which is nothing but your amortization, depreciation on your asset. Then any remeasurements which are happening, rent concession and rent concessions. But lease modifications will go as part of lease liability. But there are rent concessions that will go into your P&L. If you see cash flow, your variable lease payments, which is not in liability, low value and short-term lease payments, and actual cash outflow for lease liability. That will come under your cash flow. So this is how it will be there in the financial statements of the lessee.
What is that lease liability separate from other liabilities?
Which one?
First balance sheet.
Hmm.
Payable for short term and low value leases. ROU okay, lease liability okay. Payable for short term and low value.
If it is less than 1 year, if it is less than 1 year or so, some low value assets, you will depreciate it in the same year when it is taken. So in those cases, you have to show it, you will not show it under ROU asset or a lease liability. Normally, if there is any payable for that particular short-term lease, that will come as a separate payable in your balance sheet. That is what we are trying to tell you. If there is any payable for a short-term or a low-value asset.
That means automatically go to operating lease.
If it is not paid, there is some balance sheet item coming na, it will not go under ROU asset or lease liability. Normally, it's expensed only, but any portion payable relating to that short term, then it should not be clubbed with ROU asset or lease liability.
Interest expense on lease liability. How you calculate that quantum? Lease liability separately from depreciation or ROU asset. Interest expense, because he is not paying any interest now. What is that? Interest expense on lease liability. Third one.
See, one is on the asset that you capitalize, the amortization that happens over the lease period. And the lease liability is nothing but you're discounting using the present value of cash flow. No, the interest cost that you will incur for that portion you have to take it as part of your finance cost. When you're discounting, you're identifying your present value of cash flow using a discount rate. So what is that finance cost component pertaining to that discounting cash flow, that you have to take it as your interest cost.
The cash flow statement, it is from investment activity. Three main classification we have. Financing activity, operating activity, and this will be coming under cash flows.
No, it will not be investing. It is from operating activities only, because financing and investing it will not. So this is the disclosure in the lessee books. As we see for the ROU asset, we saw the main thing is on depreciation, and on the lease liability, it is all your interest expense and your outflow which is there, and your P&L, it is mainly or low value assets or short term assets which is coming up, and in your other disclosures will be in your cash flow, where you will have your lease payments, you will have your period of the lease, and then any other sale and lease back transactions, anything which is coming up where additional disclosures are required. That is as far as lessee accounting is concerned. Then we go to lessor. So with respect to lessor accounting, a contract that contains a lease component and one or more additional lease or non-lease components, then lessor has to allocate the consideration as per 115, which means what is the specific standalone selling price at the date of the contract. So how does he determine the standalone selling price? One is adjusted market assessment, where he will estimate the price a customer in the market will be willing to pay for the goods. Second, the cost plus margin. What is the forecasted cost of providing services plus a markup? The residual will be to what extent you can identify the standalone price, and from that, what you will allocate it on the proportion of the standalone selling price. You will estimate what is the price for the specific components which is there as per the agreement, and for the balance you will use a residual approach. So where you are not able to clearly say what is the total price which is attributable. So the three ways in which you will determine the standalone selling price for a lessor. So from a lessor perspective, these are the various definitions. Like the lessor, he provides the right to use an asset for a period of time in exchange for consideration. And again, there are payments which are there, and then you have the net investment in the lease. Okay, if the gross investment discounted at the interest rate, which is implicit in lease, then your gross investment in the lease, like lease payments receivable by a lessor under a finance lease and any unguaranteed residual value. Here also you have your initial direct cost, your residual value guarantee, and your unearned finance income. So these are also some of the terms which comes in the books of the lessor. How we will account it is coming in the next slide.
In the previous slide, that lease payments, no? That should be actually lease receipts, no? Is an income, no? For lessor, under books of lessor. Second, lessor.
Correct. This we say, when you see the heading, it is lease payments, payments made by lessee to a lessor. So when it is made by a lessee to a lessor, we had listed out like that, but when it comes to a lessor, it is not a payment for him. So for a lessor, if you see the last line, lease payments include any residual value provided by the lessor. Apart, you have to only consider the residual value, adjust it, and that is what is the amount the lessor will receive from the lessee. So here also for classification, it starts at the inception of the lease and it has to be reassessed at every lease modification, and based on the substance of the transaction, like as I said, each and every contract you have to go through, and the intention of the management also has to be looked into, not only the substance of the contract. Say for example, a car lease for 12 months with the lessee, or a laptop for 1 year. So whether it is a short-term lease or based on the intention, you have to see the nature of the specific transaction. So lease transfers, see the finance lease, we told in the previous few slides, like these are the conditions for finance lease. So once this is getting satisfied, it becomes a finance lease, otherwise it is a lease. So the conditions is ownership of the asset transfers to the lessee at the end of the lease term. Lease term is for the major part of the economic life. The lessee can cancel the lessor's losses and are carried by the lessee. At inception date, present value of lease payments is substantially all of the fair value. Asset is of such specialized nature that only the lessee can use it without any major modification. Lessee has the option to purchase the asset at a price lower than fair value. Gain or losses from fluctuations in fair value accrue to the lessee. The lessee can continue lease for a secondary period at rent substantially lower than the market rate. So the conditions for classifying as a finance lease, if these conditions are not getting satisfied, then it becomes an operating lease, where the lease does not transfer substantially all risks and rewards incidental to the ownership of the asset.
Madam, here, ownership, actually, it is only giving option, no? Ownership of the under assets transferred here at the end of the lease term.
It is only an option.
We cannot say at the time you may not know.
Correct. It may or may not. But if there is an option of the underlying asset getting transferred at the end of the lease term, then it becomes a finance lease. But it is an option as of now at the time of entry.
And operating lease outside the scope of this India. Then that is not
Straight away, straight case.
outside the scope.
Correct. It is not identified as a lease. So allocation of lease payments, if there are both land and building elements in the same lease. Suppose the lease includes both land and building, you assess the classification of each element as a finance lease or an operating lease separately. So you will consider the land normally has an indefinite economic life and you allocate the payments. How much you will allocate for land and how much you will allocate for building. So allocated proportionate to the relative fair values of the leasehold interest. So building means the lease payment should reflect what is the return on investment in building, any recovery of building value. So when you can allocate separately or you can combine the land and building. If the value of land is immaterial to the lease and the building's life is equal to the life of the combined asset, where the life of the building is almost equal to the total life of the asset. So here they are saying you have to allocate based on the fair value of land and building. If we say, if you have given a building for 5 years lease, the lease payment has to be determined in accordance to your, the recovery value. So when we are not splitting the land and building, then the useful life of the building, if it is almost equal to the life of the total asset, then the life of the building has to be taken. So what we are trying to tell is, normally the assumption goes as a finance lease unless and otherwise we are clearly able to substantiate that it is an operating lease. So this is the from a lessor perspective, where it is the date is at the commencement date. You recognize the net investment in the lease, including your initial direct cost. Then your initial measurement, which is net investment in lease. How do we arrive at is the if it is a manufacturer lessor and if it is other lessor other than manufacturer, how do you arrive at your initial measurement in your books? Then what is your subsequent measurement? How do you arrive at that? And if it is classified as held for sale, then how do you do a subsequent measurement as per Ind AS 105? So this is more from a lessor perspective. Subsequent measurement if you are holding the asset for sale. So this talks more about where we saw the net investment in the lease, how the computation is getting done for the net investment in lease. So basically what we need to look here is giving the asset on lease to the lessee. It becomes a finance lease and the same will be transferred to the lessee, and in that case the asset will be de-recognized from the books of the lessor. So if it is a finance lease and if the asset is getting transferred at the end of the lease, what we are trying to say is it is getting de-recognized from the books of the lessor, and consideration received will be is the gross amount, which means you also consider your unguaranteed residual value, where at the end of the lease the value, what value that the lessor will get, say when he sells that particular asset to a third party. So that adjustment has to be made to arrive at your final cost or your investment. No, normal, that is at what rate that lessor will sell it to the third party. Then you have a lease modification, similar to how we saw in lessee. For lessor is also there are lease modifications. So it will apply, because in a contract if there is modification, it will apply both to lessor and lessee. So if the consideration is the same as the standalone price for the other leases also, then it will be considered, say, as a new lease. Suppose if we saw the earlier example, say the second lease is taken for a lower amount than because of the first lease, then it becomes a modification and it need not be considered as a separate lease. So lease term as well as the discount rate both has to be reassessed at the time of modification. For all the modifications, if you see, you have to arrive at what is going to be your cash flow, what is going to be a revised cash flow on account of the modification, compare it with what was the old net investment, and the difference between the old and the new value that will be taken into your P&L because of your lease modifications. So this is a straight way of accounting for operating leases, where it goes straight to your P&L. There is nothing much here. And your presentation and disclosure, lessor shall present underlying assets subject to operating leases in its statement of financial position, like what are finance leases. Then if there is any operating leases coming in, separate income relating to variable payments, whatever needs to be given, and further information, qualitative or quantitative, whichever it is required, that can come in. Any other additional information which is required, about the nature of the lessor, the leasing activities, how the lessor manages the risk associated, risk management strategy, all these additional disclosures, if it is required, can be given. Net investment and whatever, balance sheet made is a net investment, and P&L it will go to income. Balance sheet, it will be because it is the asset of this lessor only. No, you are giving it on lease to that person. He will use it as an ROU asset. Then here he will compute that whatever is your net investment. That is what we saw here. So here also, net investment in the lease.
And P&L credit side.
Correct. Sorry. So this is the disclosure in the books of the lessor. If it is a finance lease, where you will show if it is less than 1 year, 1 to 2 years, 2 or 3 years, and similarly on the way of operating lease also. So finally, we come into a sale and leaseback transactions, because some agreements will be entered into where there is a sale and leaseback. So is the transfer of the asset a sale? Then we determine when is a performance obligation getting satisfied for the seller. So if the transfer of asset is a sale, then how does the seller or the lessee measure the right of use asset at the proportion of the carrying amount for the right of use? Lease liability will be the residual amount, and you only recognize only the amount of gain or loss that relates to the rights transferred to the buyer or the lessor. That is from a seller angle. From a buyer angle, you will account for the purchase of the asset, and you will apply the whatever is the accounting requirements under 116. If the transfer is not a sale, then you continue to recognize the transferred asset, recognize the liability equal to whatever is your transfer proceeds from the seller's books. From the lessor's books, you do not recognize the transferred asset, you recognize only a financial asset. So when we see an example, we can understand, like say sale and lease back. Transfer is a sale at fair value, and lease back is a finance lease from a lessor's perspective. Say an entity A holds a ship at a carrying amount of 8,000. Entity A enters into a contract to dispose of the ship to entity B for its fair value 13,000. At the same time, entity A enters into a contract to lease the ship back from B for 20 years. So I sell it to him and I take it back with an annual payment of 900 in advance each year. So the interest rate implicit in the lease is 5%, resulting in the present value for annual lease payments of 11,000 and odd. So the lease payments are considered to be at market terms. The transfer of the ship to entity B is determined to satisfy the requirements in IFRS 15 to be accounted for as sale. So how do we account? Entity A recognizes the disposal and the acquisition of the right of use asset. So the right of use recognized by A is proportion to the carrying amount. So how do we calculate? 11,177 divided by your 13,000. So 11,777 is your present value of lease payments, and your fair value is 13,000. So you arrive at 0.906, and the right of use asset, how do you calculate? You apply this on your carrying amount of the whatever is the carrying amount of the particular asset. So then you have the right of use asset. The entry which you will record is cash, because you are selling at 13,000. The fair value of the ship is 13,000, and you are getting cash at 8,000, because the carrying amount of the asset is 8,000. You are selling it, the fair value is 13,000, so you get cash for 13. The 8,000 is the carrying value. Then the ROU you have computed basis the rate which you have arrived at. Your lease liability is nothing but your discounted lease payments, and then the difference goes to the gain or loss.
These entries are in lessee's books, right of use account.
Lessee.
Lessee.
Seller is a lessee, and sale and lease back.
Then one more thing is that the sale and lease back should happen in the same year to coming all these things. Within one accounting year, this should happen. Suppose it happens next year, this will not reflect.
No, the agreement has to have a sale and lease back. Then we can account it in this manner. Correct.
But what benefit, madam? Sale and lease
I don't know the immediate benefit of it, but many is happening, like they go for a sale and lease back. Maybe they are getting it at a better rate or something. I'm not sure on what is the advantage.
You will get a lump sum amount, and then you will stagger your payments. That will be the benefit.
Then everybody can go into sale and lease back, no? But not sure, like as you said, right? You are getting a payment upfront, and then you're getting an income upfront, and you're staggering your payment. But then that sale and lease back can apply to all transactions. But yeah,
Live cases. So many,
sublease also many cases anyway. This is in the books of the lessee, where the entity A who is selling it and who is leasing it back. In the books of the lessor, these will be the entry, like the asset at the fair value, which is 13,000. So asset to cash, and he will recognize the purchase of ship as a finance lease receivable to the asset. Because what happens here is he is selling it off, so he will de-recognize this from his books.
but he is purchasing correct. Sale and lease back. But he is not selling back. Now, why the asset account is credited?
Because he is taking it as a lease receivable. He is selling and leasing it back. Sale and lease back.
No, what he is asking is, why should the asset go out of the books?
He is recognizing it as a lease receivable, no? The asset is going out, and then it is basically a sale and you're leasing it back. So the de-recognize the ship and recognize the lease receivable. You're de-recognizing your asset under finance lease and recognizing it as a lease receivable, basically.
This is also separate line item, finance lease.
Huh. Finance lease receivable, yes, correct.
This, allow me to give mail or something.
I will send, sir.
Take out the entries are.
Yeah, no, I understand. No, because this, even I was thinking how to explain, but only through an entry you can understand sale or lease back. Otherwise, a concept and all is very difficult to do. So, how to simplify is what I thought of. So, I think that is all what I had for this session. Maybe I was.
So that way, nobody will own the ship, as she was asking. Who's the owner? The ship is not there at all, but it is getting leased.
Sale and lease back.
The asset is nobody's books. And ship cannot be like that.
See, asset is in nobody's books, no. It is in the books of the lessee as an ROU.
It's not being shown as a ship. This was separate item.
Not being shown as a ship, but it is tangible as ship, but it is an ROU in the books of the lessee. If you say it's a PP&E, is it a asset for me? No. It is. It changes into ROU, and there it becomes a finance lease receivable.
I think that definitely cannot be taken out of the books.
Hello. Thank you, sir. Yes. Yeah, I now request C.A. Ravi sir to have a thank you note. Yeah.
It's my pleasant duty to perform a vote of thanks to the Speaker of the Day, who has done a wonderful job. It's AS 116 itself. It's a difficult topic to understand and do it from our own perspective, but to stand in front of an audience and then try to make them understand the first principles of this subject. It was a wonderful job. I thank her for this very good effort.
Madam, I don't know even the basics, like what is operating lease, what is financial lease. I don't know anything. At least something I gained because of you. Very thankful to you to share your knowledge and taking your pains all the way coming here. I'm very, very thankful to you, actually.
Thank you, sir. Whatever minimum I do, I share, but anything else coming up also, definitely happy to share with at least our peer group.
Yes. Anybody have anything to say? Okay, ma'am. Thank you, ma'am.